story. What do
Yes.
you mean by that, and what are you looking for in companies?
So classically, people might look at dividend yields for just utilities, but they're really bond substitutes. They're not growing their dividend. So we prefer companies that have the ability to grow earnings, which then allow them to grow dividends down the future. So we look for high quality companies. We focus on free cash flow, return of good return of capital, and we look for companies that are shareholder friendly that have a record of increasing dividends. So to give you an example, at the portfolio level, we can build a portfolio of dividend stocks that's yielding about 3%. Now you compare that to something like a 10-year treasury that's yielding 2.7, but on this portfolio you can get 3% and it grows at a rate of maybe 10 to 15% a year. So we think that'll outperform easily bonds over time. And for investors who need some return or distribution out of their portfolio for retirement, that dividend yield is more certain than, say, a capital gain.
So give me an example of a stock that meets your criteria.
Okay, one stock would be Eaton. It's a diversified industrial, big into construction, both residential, non-residential, and trucking. This is a company that pays about a 2.5% dividend, but it's grown its dividend in 10 to 15% range consistently. It's relatively cheap right now, and we think as the economy recovers, they will have very good earnings power, and of course that earnings will translate into higher dividends. It's always important to pay attention to valuation on these dividend growers, by the way.
It's interesting though, because it's a cyclical company, and the fact they've still been able to consistently grow their dividends, because obviously during slower economic periods you would think that maybe that would not be the case. So it's made it a priority. The company
It is. That's a management priority. That's something very crucial to look at.
Another area that we never used to traditionally talk about when we talked about dividends was technology. And Texas Instruments, it recently upped its dividend by about 7%. So when you look at a company like this, it's in a bit of an interesting business, right? There's a lot of disruption, if you will, in certain aspects of technology. But you're confident that dividend growth will be able to continue?
Yeah, for one thing, technology is actually becoming a very good target-rich environment for dividends.
That.
15 years ago it was all growth. Now you got a lot of mature companies, and the market's rewarding companies for paying dividends. In Texas Instruments' case, they're actually very big in the analog space, which is it's not as commoditized as digital. Texas Instruments has built up a lot of capacity in that area, and they've got very good bookings. Their book-to-bill ratio is good. They're going to grow their earnings, and they have committed to returning 100% of their free cash flow back to shareholders. And with a 3% dividend yield, that's pretty nice.